Good morning. You're listening to Insurance Matchmaking, your path to health, life, and Medicare coverage with Matt Libby Insurance. And now, sharing his knowledge, here's your host, Matt Libby.
Good morning. Welcome back to Insurance Matchmaking. Been doing a lot of traveling lately, and business travel, not for fun. I think I talked a little bit about it on the last show that I went down to Tupelo. I went down there a couple months. If you were listening to that show, went to what they call the agency boot camp, and actually Elijah is down there right now as I'm recording, doing the same thing I did there. And then, but last week I went down for what's called behind the agency, and it's just a kind of a strategy planning, how to scale your insurance business, how to best practices with adding agents and marketing, things like that. Got a lot of good information out of that, and one of the things that's great on that is they go ahead and they record all the sessions, so I can go back and review and say, try to remember, what did so and so say here? I know I took some notes, but now I can't figure out my notes. I can watch the video and go, oh, yep, that's what I was saying. So that's going to be great. So hopefully that will help us. And as I've been saying the last few weeks, it's almost enrollment season. We're just about a week away now, and actually, as you listen to this, we will be in October within a week, and that's when I can do the Medicare reviews. I sent out some information last week on an email to anybody that was on my Medicare list. So some of the people were not necessarily clients, but they were in my contact system because they had come to one of my Welcome to Medicare workshops or something like that. And just reminding, hey, if you want my help with your Medicare, here's a link. You can send some information to me, and with who your doctors are, who your prescriptions are, and that way I can go ahead and kind of get some of that data entered into the system. So on October 1st, I can do those reviews and start making recommendations and not be asking for them then. And the thing is we can't enroll anybody until October 15th. I was listening to a podcast yesterday, and obviously, we have 54 days. That's the time we have to do a enrollment for a Part D prescription drug plan or Medicare Advantage plan so that it will take effect on January 1st. And so I had a few people I had to call back, and because I also sent a link to the calendar to go ahead and schedule appointments. A couple of them scheduled them for this month. I really can't do anything. And we could talk, but it's the purpose of getting those advance information is so when it's time to make a recommendation, I can. And I absolutely, there's just no way I could, not just legally can't make it before October 1st. I just physically can't either. I have some ideas. I could, I've told a couple people, hey, you're probably going to keep what you have, but let me get back to you after the 1st, and I'll let you know about that. So that's kind of the things with the Medicare. And I say, and I love the fact I've got a really good response this year from clients. In the past, I didn't get that many, and then it's the last week of enrollment. They go, "Oh, I haven't reviewed my stuff," and it's like the old make hay while the sun shines. Kind of like, and I know I've said it on here before too. That the tax season for the accountants. You don't invite them to parties in April because they don't have any time for anything but doing tax returns. That's kind of the way we are here in the annual election period for Medicare. I do a big bulk of my business this time of year, and sometimes it's working with existing clients, changing their plans, rewriting, or just going over and reviewing and say, yeah, you're set. We don't need to make any changes, and that takes a lot of time. I only have so many hours in a day and so many days in a week. I usually work on Saturdays during this time of year, but that's when I also get a lot of new business. So that's why I want to try to and the new business usually comes at the end when the people go, oh, wait a minute, I forgot. And of course the TV ads increase at that time from the national advertising. And then they go look for somebody local, and they find somebody like me, and then I'm able to get a new client. It's great. I want to have those appointment slots available to get that new business. And most of my clients, they appreciate that. They want me to be successful. As long as I'm successful in continuing, they know they've got me there to help. If I get to a point where I'm not making, I'm spending more money to with the overhead of the business than I get a new business, I might as well go ahead and retire. So let's work together there. The other thing I kind of wanted to touch on this morning is I did this last week, they opened up the recertification for the healthcare marketplace, the FFM, Federally Facilitated Marketplace, for the Affordable Care Act, also ACA, also known as Obamacare. We have to recertify on that every year, and fortunately, it only takes a few minutes. Just have to go through some slides, they call it check on learning. You do little practice questions, and I missed some. And some of them were kind of nitpicky because it was like one, I answered no, and maybe was the right answer. And another one, I was like, yeah, let's try this. What could be maybe, depending how they're asking the question, of course. And that one, the answer was no. But I understood the gist of what they were talking about. And I know how to handle those situations, but you got to get the right answer on the test. So, but I didn't have any problems getting through the final exam. Of course, the only one that I did miss on one question, and it was because there was multiple answers. And so it's kind of one of like, okay, is this one also correct, or leave that one off? And I don't think I answered more, I don't think I checked more than were correct. I think I left one off. That one could be, couldn't be. Of course, they still count that as a wrong answer. I hate those kind of questions. It's like, one answer for a question, not it could be one or it could be four. That's too much. And a lot of times it's funny when we do our tests. Usually it's like if all of the above is a selection, that's probably the right answer. So, but some people get tripped up. Some people get tripped up that way because they keep doing the all of the above when it's a solution, and another one that was not the answer. So anyway, I printed out a sheet from the training that I did for the recertification, and talks about the maximum annual limitations on cost sharing, and then the percent of. Well, I'll go over the maximum out of pocket, and then I'll explain the other part, because the way what they call it is kind of doesn't really explain it. But in 2026, the maximum out of pocket that you can have on a health plan as an individual is $10,600. For a couple or a family, you double that to $21,200. So everything. And that's the thing. Usually when I talk about deductibles, I'm usually talking the individual. Some people want to call the max out of pocket their deductible, which isn't. I understand the point of view, but the thing is, the difference between the deductible and the maximum out of pocket is once you hit that deductible, you do have cost sharing, whether you're paying 50%, 30%, 20%. The insurance company is paying some of that cost once you hit the deductible. And then when you hit that maximum out of pocket, and why some people will refer to it as their deductible, is you don't pay anymore after that. So if you think of, you think of it like your car insurance, your homeowner's insurance, you pay the deductible and then the insurance pays. With health insurance, it's just a little different because you do have that cost sharing, the co-insurance, as they call it. And actually, even I think sometimes I'd have to ask one of my P&C agent friends, but I think sometimes there's like co-insurance on homes and such. So like with a roof, you may have a deductible. Could be a smaller, and that's sometimes to get a smaller deductible, you take on that co-insurance expense too. So what happens there? You may have, say, a $2,000, and I'm just saying numbers. Don't roast me. They're P&C agents that I don't know what I'm talking about. But say you have a $2,000 deductible on your roof, and then you have a 1%, 5% co-insurance. So everything over that $2,500, you're paying a small percentage of it. So the insurance company isn't paying all of it. And I think some of the plans are doing that. I don't think that's the way mine is, but I think I have seen that. And again, that's why I say I think, because I'm not positive, so don't hold me to it. I don't have a property and casualty license, so I have to be careful speaking on those things. I'm not an expert there. I do know people that are very good in that, so if you have those kind of questions, let me know. I'll pass you on to someone who can answer those. Now, if someone has reduced income, and I don't know why they broke this down into the three levels, because the 150%, 200%, 250% of the poverty level, those do have some significance, but in this part here on the maximum out of pocket, they're going to be the same in that it's $3,500 for an individual for all three of those levels. We did have the the 150% of the federal poverty level special enrollment that someone could enroll anytime during the year in a marketplace plan if they hadn't signed up before, that special enrollment has been eliminated, just like the extended subsidies will expire on December 31st. So everybody's going to have a little bit of an increase in their plans. It's not going to affect, again, those that much that are in the lower, below that 150%. But so anyway, if you're at 250%, I read this chart wrong. So the 150% of the poverty level and 200% has a $3,500 maximum out of pocket, and generally most of those are not going to have that high of a max out of pocket, because below that level it's generally going to be less, and I'll go over that in a bit here. But at the 250%, it goes to $8,450. And what it is, anybody under that 250% qualifies for what's called the cost sharing reduction, and you can only apply that to the silver level plans. So it's yes, you could maybe have a zero premium on a bronze plan with some copays, but something major happens, you can have a lot of money out of pocket. Whereas with the silver plan, and you have that cost sharing reduction, you're going to pay a little bit of a premium, but you're going to have lower copays, you're going to have a lower deductible, and a lower maximum out of pocket. So that can be very affordable for some of those folks that are on the lower end of the income spectrum, below 250% of the poverty level. Now, those that are close to that 250, if they're considering the silver, I've had a lot of people go ahead and pick a gold plan, because the price difference between the silver and the gold this year, now next year could be different, was only a couple dollars. I mean, literally a couple dollars or less. It was like $1.50 to $2.30 would be the difference between a silver and a gold plan. And if you were closer to that 250%, you maybe still had a lower deductible and lower copays on the gold plan. Now, your max out of pocket would probably still be less on the silver, but all the other expenses were less. And again, that max amount out of pocket, if you have something catastrophic happen, you're going to hit it even on the bronze plan, or you're not going to hit it except, unless it's something major, a car accident lands you in the hospital, a heart attack, getting diagnosed with cancer, something really serious that's going to add a lot of expenses, you're generally not going to hit that maximum out of pocket. So that's how those are working. As I mentioned, the numbers, they just double for a couple or a family. The family rate is the same as the rate as for two people. So, and I say it could be a couple, or it can be a single parent with one or more children. It would still be just double that individual deductible. So then we have I'm trying to read how this, but it's your premium is going to be based on that. They use that benchmark silver plan, and then you have your premium percentage. So up to 100. So from 0 to 133% of the poverty level, then your premium would be 210. 2.1 or 2.10% of the premium, and then at 130 to 150%, 133 to 150%. And I know I'm reading a bunch of numbers. It's kind of hard to follow on the radio because you're not looking at what I'm looking at. But so if you're closer to that 130%, your premium is going to be about 3.14% of that benchmark plan, and then it's kind of a sliding scale up to 4.19% if you're closer to that 150%. And so it's just a percentage of how they figure, what your subsidy is. So you're paying that much of that premium. So basically, one of the things that's going to happen here on the silver plans, a lot of people on the lower income qualified for a zero premium on silver plans. And the way I'm understanding what they're saying is pretty much because they're removing the enhanced subsidies, that somebody on these lower income levels, like 130 to 150% of the poverty level, they are not going to be qualified for a zero premium silver plan, but it's still going to be greatly reduced. But they may have to pay $20 a month or $30. I don't have the numbers, but it's going to be, if you want a zero premium, you're going to have to take the bronze. The downside of taking the bronze plan is something major happens, you're going to have a lot of expenses. And that's why we always try to encourage our clients. And I'm sorry, I went over the break, so let me pause here and let the commercial break come in, and then I'll regroup.
Tri-Lite, the people who bring you better internet, are now bringing you better wireless. Introducing Tri-Lite Mobile, a new wireless service for our area. Enjoy nationwide coverage, the freedom to bring your own device, and budget-friendly plans, all backed by the local team you know and trust. Right now, when you sign up or upgrade your internet service, you'll get your first line free. Ask about Tri-Lite Mobile today. Call 833-847-0824 or visit trilite.net. Some restrictions may apply.
Join Habitat Restore at their pop-up donation event every second Saturday of each month at First National Bank in Sparta. The Habitat team will be there ready to go to receive your donations. So don't miss an opportunity to declutter and make a difference at First National Bank in Sparta with the Habitat Restore pop-up donation event every second Saturday of the month.
And now, back to Insurance Matchmaking with Matt Libby Insurance.
All right, welcome back. Just before the break there, I was talking about how the premiums are going to be for folks on the silver plans and the bronze plans with the reduction of the enhanced subsidies for the ACA plans. And one of the big things there is a lot of people were qualifying for a zero premium on a silver plan, so it was kind of like a no-brainer. And I think I still think they're going to be affordable for folks. It's just you're just going to have a little bit more of a premium than you've had maybe this last year. So be prepared for that. But the other thing I started to say before the break is we always encourage our clients to look at those supplemental plans, sometimes called ancillary, that, critical illness, accident, hospitalization plans. And the reason I bring that up is a lot of people will look at a plan and go, oh, $7,000 deductible, I could never pay that. You're right. Hopefully you never have to have it. But the thing is it really worth to pay extra $200 a month to have a $3,500 deductible? That's still going to be hard to meet. We can supplement, especially if you're younger. The rates are always lower. I mean, accident plans are generally going to be about the same. They're usually the same for everybody because they're just, if you're an adult, this is what you pay for a flat amount on accident. But illness things, hospitalization, cancer plans, heart attack plans, life insurance, all those things are going to be a little higher as you get older. But when you're younger, they're lower. And one of the things I try to stress to young people, and some people say, well, I don't want to pay anymore, or they want everything covered when they go to the doctor. And most of you can get a bronze plan, a lot of times get a bronze plan with a zero premium and still have some co-pays when you go to the doctor. But if you have to have a major test like an MRI, or you have to have outpatient surgery or something that lands you in the emergency room, you've twisted your ankle, think it's broken, you go to the emergency room, those kind of things. Those are going to be expensive visits. If you get admitted to the hospital, of course, you're going to have some expensive charges. But if you're paying an extra $250 a month to have a lower deductible, you're still going to have that deductible. You're still going to have co-pays. They'll be less than the bronze plan, but you're still going to have those expenses. And on a young person, we can put some very sound coverage that will cover for those high deductibles and probably still have money left over, which will help, and it helps cover those expenses that you are incurring and you're not working, and so you don't have a paycheck coming in. And you still do that for a lot less than adding that silver plan. Or if you're thinking about getting a silver and you don't have the cost sharing reduction, so you decide, well, I want a gold plan because it has a $1,500 deductible instead of a $3,500 deductible. $2,000 difference, but you're going to pay $3,000 more each year in premium to have that lower deductible. And again, most people aren't going to have the deductible. You're going to have the deductible. Most people aren't going to meet the deductible in that year. Unless something catastrophic happens. And that way, if you have some catastrophic insurance, that's going to cover it. And like I said, you can get a $25,000, $50,000 cancer plan, for $20 or $30, and that's going to more than cover your deductible, and it's going to cover some missed work and everything else. And the beauty of those plans and most, I can't say 100% all of them do, but most of them do not go up as you get older. So when you're like my age and you get it when you're in your 20s or your 30s or 40s, and in your 60s like me or 70s, you're still paying the same amount on that plan and can use it. And a lot of them a lot of plans we have what's called restoration of benefits. So it's just like with your health plan that those deductibles reset. Well, the benefits on a lot of these plans reset also. Maybe not so much your critical illness. Some of them will have a recurrency benefit. So like if you get cancer and then you get cancer again, it will pay again. But a lot of plans, and that's an add-on. So it's like if you don't add it on and you get cancer, it's going to pay out a nice lump sum, which is going to pay more than you ever paid into it. But then it's done. And so it's not going to pay again. But the hospitalization plans, they have what's called restoration of benefits. So if it pays so much per day or so much for one day in the hospital, that's in a year. So it's like if you go to the hospital and you've got something that's going to cover your deductible, say $7,000 deductible, and you go in the hospital, it's going to pay that $7,000. But if you go in the hospital 3 months later, it's not going to pay, but you've already hit your deductible for your health plan now because you were in the hospital before, so you're probably okay in that sense, monetarily anyway. And then the next year it resets, so if you go in the hospital again, in the next year, it will reset. I heard somebody talking about somebody had a plan, because a lot of times if you add a rider for outpatient surgery, it'll pay a certain amount, whether you get $250 or $500 or some of them even up to $1,000 per outpatient surgery, and it'll pay twice. And I'm trying to remember now what the incident was, but the old people like myself usually end up having cataract surgery, and they don't do both eyes at the same time, so that's 2 different surgeries. And so if you have a plan that covers that, and I can't remember what, but anyway, somebody had gotten their policy, and I don't know if it was knee replacement or it was something. They had 2 surgeries, and then after the first of the year, because this policy reset on the calendar year, and then they had cataract surgery, and so they were able to get the payout to help defray some of the costs for the outpatient surgery on all 4 surgeries that were only a couple months apart, but they were in different years. So there's some things, sometimes it just makes sense to put things off, and sometimes it makes sense to hurry them up. I've talked to a lot of folks that we're getting up to close to the end of the year, and maybe in looking at, should I wait until after the first of the year to have a surgery, or should I wait till I'm on Medicare? And it's like, well, how much have you paid towards your maximum out of pocket on the plan you're on? Again, those silver plans with the cost sharing reduction, some of those have some very low, depending on income, very low max out of pocket. And so the one client I was talking to, yes, if you go on a Medicare supplement after the first of the year, then it's probably going to cover. It will cover, but if you decide to do a Medicare Advantage because you like the zero premium, then it's going to be you're paying those outpatient surgery copays. And the downside there too is if you told me you're getting ready to have a surgery either before the end of the year or soon after you go on Medicare, I can't write you a hospital indemnity plan at that point because you have something upcoming. We can't get ancillary supplemental insurance to cover things that you already know you're going to have done. But if you didn't know they were going to happen, you get the insurance, and a couple months later you go to the doctor, and the doctor goes, "Oh, we need to do this surgery." You're covered because you've been on the plan, and it wasn't something you knew about before. That's the same thing like with cancer. Cancer plans. Now, here's the catch on that. Most cancer plans, if you're diagnosed with cancer within the first 30 days of having the plan, they're not going to pay. So if you think you're possibly having some issues that you think could be a cancer thing, or some symptoms, and you're doing Dr. Google to figure out what your symptoms are. Oh, that sounds like cancer. I probably better get a cancer plan. And then you go to the doctor 2 weeks later and they're diagnosed with cancer. It's not going to pay. So if you're got your physical upcoming, well, get that insurance plan at least 30 days prior to you having your physical, because that's when they might find something. So you're going to have a physical. They're going to do blood tests. When it asks the question, do you have any upcoming tests that haven't been performed, you can still answer that question no, even though you're coming up on the time for your annual checkup. But if you're scheduling an appointment because you think there's something wrong, you really have to answer that question yes, that you are awaiting tests. That's why I tell people, if you think there's something going on, go to the doctor. If you get, they clear you, come back, we get to the policy, and you won't have to worry about that going forward. So Cancer plans are very inexpensive, but if they have to pay out, you're going to get back more than you paid in. And a lot of plans have what's called return of premium. There's some life insurance plans also that do that you pay in, and after, with the like cancer plans and things like that, it's like 20 years. There is an option also, depending on the plans you can do, where you can request the 20 years or pay out upon death. And so it'll work kind of like a life insurance policy that, hey, you paid into it so much every month for 20 years, 25 years, you pass away, your beneficiary gets the return of premium. And it's not income because that's money you paid in. It's just being returned. So it's not taxed like if you inherit property or stocks or things like that. So it can come in handy. It can help, you can, instead of buying burial insurance, buy a cancer plan that repays upon death. So it's kind of like a forced savings account, but if something happens, then it pays. So there's ways you can use insurance to protect your income or protect your nest egg to pass on to your heirs. So keep in mind that a lot of insurance, and that's one of the things I talk about between the difference between term life and whole life. Of course, some term life plans have that return of premium, but with a term life plan, 10 years, 20 years, 30 years, you pay so much into it, you don't pass away. Thank you very much for paying us. Congratulations, you didn't die. And then you can't afford to renew that policy now because it's just so much more expensive. A final expense plan is a whole life plan. It is going to pay out. And even if you pass away, some plans, depending on your health, you get a graded or a guaranteed issue plan that if you pass away in the first year or two, it just returns the premium, but plus interest. So you're still not losing the money. You have to figure it into your budget. Can you afford to set that money aside? But I've had people, say, well, what if I could just save that money? Well, the problem is you pass away in 6 months, you didn't save $10,000. But if you had that life insurance policy and you pass away after 6 months, it's generally, most plans are going to pay out because you didn't know you had any health issues. You didn't fraudulently get the insurance, and it pays out, and you have your benefits that go to your heirs, your beneficiary. So the money comes back, and generally the way they price those out, it's if you live to 110 or 120, the cash value would equal what you paid in. So you're still gonna get more back out than what you put in. So anyway, it looks like I'm running out of time here. Remember, as always, at Matt Libby Insurance, we can cover you from head to toe. It doesn't have to cost you an arm and a leg. And like I said, as you're listening to this, basically you can set appointments for the next following weeks for your Medicare. And then on November 1st, we will start doing the ACA enrollments. So if you're under 65 health insurance, we do that in November. There's some forms and stuff we'll need you to fill out, to get ready for that. But again, those appointments need to start in November. Being early doesn't help. We have to wait, and we want you to be early, get together in November, not December. But October is too early to talk about the Affordable Care Act. Under 65 health insurance, just like September is too early to talk about your Medicare for next year. So see you next week on Insurance Matchmaking.
You've been listening to Insurance Matchmaking with Matt Libby, your path to health, life, and Medicare coverage with Matt Libby Insurance.